All right, hey, thanks for joining me today. What I want to do is share with you some thoughts about a 0-day butterfly to growing a small account. So we're going to go ahead and kick things off. Remember, anything shorter duration, a little more risk. But when you're trying to grow a small account, you're trying to do a lot of recurring trades. Just repeat the trade over and over again and create a greater degree of frequency in order to kind of build up and grow that account. So you're trying to do, like, let's say 200 trades, 500 trades, and nibbling a little here to be able to kind of grow that account. All right, so let's kick things off and get stuff started. By the way, if you do want to work with me and you're struggling with some of these trades, check out the tradersfly.com website. This is where I have the mentoring program where I work with people for 3 months, 6 months, 9 months, or even up to a year. And we work one-on-one together. You get access to courses that I have as well and much more. All right, so let's go into this butterfly strategy that I want to show you. So here's kind of a basic setup. We're looking to do this recurring. So a vehicle like SPX is a good vehicle because they trade quite a bit. So you can see it's got 0 day, 1 day, 2 day, 5 day, 6 day, 7 day, 8 day, 9 day, and so on. So I'm going to show you an example here on the 7 day or so you can see how the expirations kind of work and go through. So what we do is we go ahead and we buy a butterfly right here. You could do a call side, put side. You could do a couple strikes lower, a couple strikes higher, depending on which direction you believe. But really, the name of the game is really theta. If it can hang around that area, that's great. If it doesn't, well, we're trying to kind of take off the profits quickly. So if I go in and buy a butterfly, and then I'll go and right click and analyze the trade, I have the same setup right here. Okay, so you could see I have that same butterfly already set up, but instead what I've done is now take this and widened it. So I went to about 30 points width on that side. Now one's a call, one's a put, not really a big difference here. It's just depending on if you're doing somewhat directional a little bit. So here in this case, because I'm a little bit lower because the market's been acting weak, I'm just doing a little bit of a put side, just a little bit downside. And you can see here, I've got a theta of about 20. Delta is pretty much neutral and very minimal vega here. Now, if you didn't or weren't happy with this, what I'm doing is I'm risking about 205 on the contracts or $230 to potentially make, let's say, $2,000, but that's more than likely not going to be realistic. So the reason I did a 7 day right now as an example is to show you across, let's say, 6 hours of trading. What might happen is if you do a trade like this, if we go hour 1, hour 2, hour 3, hour 4, you could see how wide this will kind of spread out. It's not going to be perfect like this because, again, the days are a little different. But what you're trying to do is, let's say by the time you get to the 3rd hour and you're risking maybe $200, you know, the price might move. And let's say it's over here, you get out with a $30 profit or so. Now, sometimes it can go all the way past those levels and you take a bit of a loss, let's say an $89 loss, or you might have to be able to take a full loss, but you have to be comfortable with those levels. The other way to kind of do this is, let's say you have like 2 contracts or 2 butterflies and it kind of hangs out for a little while and it starts moving over here to this level. Well, you're up already about $100 here. So why don't you take $50, put it in your pocket, take one of the butterflies off and leave the other one go. And if it continues to go up, then that can continue to kind of decay and go a day or 2 longer, and you could try and make a little more. But again, that requires a little more capital. So it just depends where you are with the capital amount, but you could start with kind of 1 and just let it decay for a few hours and then, you know, try and take it off, because by then it might move all the way over here. And with butterflies, what's nice is there's a bleed which goes outside the range right there. For other people, they might say, hey, well, why don't I spread out rather than doing 2 contracts? Why don't I spread out these strikes? And you could do that. You could go in and, let's say I spread this out just a little bit wider. You can do that, but it does also increase the risk and capital requirement. So for 2 butterflies here, that is $1,000. And by doing, $810, by doing this, you're taking a big risk for a short duration trade. Remember, short duration, highest degree of price risk. So it becomes a little bit of a problem there. So by doing this on the S&P, and if you want to keep spreading it out even wider, yes, you do get a really nice theta. But the downside is look, you're already putting on a $1,200 trade. And if this rips down here in your face, you might have a full $1,200 loss on the trade, because it could gap down on you or gap up if you're holding across multiple days, or if you're holding just for a period of time, and you go and have some lunch and it just starts moving up, ripping in your face, you could be way over here and you're down $400. So be very, very, very careful on these 0 days, 5 days, 2-day expiration trades. Trade a tiny bit of capital because you're trying to create a lot of frequency. So if you're doing, let's say, 200 trades a year across these different days, then you'll really try to get those averages to be smooth and not overdo one or the other. Don't try to do like one massive or big trade. Try to do a bunch of tiny trades, so this way any one problem that you have doesn't go against you or hurt you. So I want to show you this as a general example and setup. The plan here would be, hey, if I'm trying to, let's say, go in with one butterfly and I'm risking 700, and let's say it goes 3 hours or 4 hours in, and I might be over here. If I'm risking 700 and I make 130, that's not a bad risk to reward. So if you do a calculator here, and let's say you're making about 130 on about 770, okay, you're still at 16% for the day. Now you'll have some losses, so let's just bump it down to about 8% overall. But what you're trying to do is keep those things in range and check. If you're struggling with the S&P is big. You could go with the SPY for practice, and that's a good starting point right there. Now, I do have some examples on the S&P right now. On the Butterfly, this is just a platform that I use for paper trading for dealing with customers. Like here is one I did with Cynthia right here. So we put on some trades. I do some things with other people. I'll just put in different trades at different spots. And I do have some S&P positions in here. And what I want to do is just show you, I put these on kind of this morning just to show you how they're progressing. I did one on the call side, one on the put side. So again, I got a boatload of stuff over here. And what I want to do is go in and show you these right here on the call side first, just to show you where we are on the call side. So this is a kind of a butterfly spread. Let me see, call. That should be correct here. But the days till expiration, go back here. Okay, and then we'll float it. So what you'll see here is this one's still kind of playing around in that range. And you'll see right now it's kind of down $60, so it's going to be wiggling a little bit. But we're kind of in the sweet spot, and the theta is around 2,000. Like there it is, wiggling around. The theta is like at $2,000. So as long as we're kind of wiggling around in that zone, it's tough to do the day thing. There it is. It's up a little bit. So you already put a closing order in. So don't wait till you see this. Put the closing order in immediately. I'll show you what I've got on the other one, which is the put side. I think that one's doing a little bit better. Let me see here. Put. Here, this one, you could see this one's kind of wiggling a little bit more. It's up about 280. The risk we have is this trade that we're risking 210, and it's already kind of making about call it 100, because by the time you get out of it, it's not going to be 190. See, because it whips around. They whip around like these shorter durations. They'll whip around. So try and get out, let's say 120, 100. And still, you're making quite a bit of cash right there very quickly. But like I said, these have a high degree of risk. The minute this thing moves down like, 10 or 20 points or up 10 or 20 points, once the market moves, this thing could be in trouble very quick. So don't put a lot of capital in these. I don't believe in these shorter term trades like they are the best thing in the world. No, they're not. They do have their place. They're great. They make money fast. But any big degree of price move, like let's say we move up 20 points in the S&P, which is just like that, it can be very quick. I could lose this, turn this into a loser very quickly. So be careful. Yeah, it looks good. Okay. Right now. But like I said, be real about it, right? So anyway, I just want to show you this concept though. If you're doing a small account and you're trying to grow it quickly, this is another way of doing it rather than just doing kind of verticals, because some people, they go in and just do like a vertical and they try to get those to expire, which is also fine. It's a different way of dealing with it and working with it. But you do have some of those additional risks that go with it. You have to have the stops in place, and you have to have, as they kind of move against you, you got to be able to kind of cut them loose very quick. So this is a different kind of trade. It uses actually less capital than the verticals, and it's a different setup. So anyway, I want to share that with you. There's other trades I have in here. If you were curious, I got these other 40 lot sizes on, what is this? This is Iron Condor. This is kind of close to expiration. So, you always start peeling these things back as they start moving. And then I've got some other verticals over here They're just straight up verticals that kind of looking to, push into higher prices. But you're always looking to, hey, some of the longer dated ones you might put more capital in. The shorter dated ones you put less capital in, and that way you don't have as much price risk, because with those shorter dated ones, there's just more price risk, and you have to be careful that because they could go against you very quickly, and you could have a pretty significant loss at that point. So be careful. But I just wanted to show you this trade strategy and concept. If you're trying to kind of grow an account, you're trying to do it one way, butterflies is one approach. And this is kind of what we work with in the coaching and mentoring program, over a couple months with different people. So anyway, thanks for joining me, and I hope to see you in one of the classes, courses, or maybe I'll get to talk to you sometime in the future. Take care.